Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
My top pick this week is NXP Semiconductors. And this is a really exciting company that you don't hear a lot about. We heard a lot about them a few years ago when, remember, Qualcomm tried to buy them for about $45 billion. Now it's a $55 billion company on its own. And they're heavily in the niche for autos. And so we hear about the semiconductor shortage, especially as it impacts autos. And they're right in there. I just watched a presentation by the semi analyst for Jefferies, Mark Lepacius, and he says they've got incredible pricing power right now. Like NXP, you think of they're in this sub industry that they call microcontrollers. So you can imagine all the little electronic devices that go in your car these days. Well, he says that's always been thought of as a sleepy single-digit growth industry, but they're ramping up free cash flow, and they have massive pricing power with supply chain shortages. They can charge the OEMs, the automakers, anything they want. So I want to take a look at this presentation. This is from May 12th from NXP. The evolution of automotive processing. Some pretty good slides in here. You should definitely look this up about their growth. And so this deck is all focused on automotive, and there's a ton of information in here. But I also want to take a look at a March 17th presentation they did on industrial IoT and edge processing. And this gets a little bit into mobile too, because while Qualcomm didn't get to buy NXP, the one deal that did go through that you may not have heard about is NXP bought the wireless business of Marvell, and they're really growing that. Right now, automotive is like 45% of NXP revenues, and industrial IoT is about 20%. Mobile's only like 15%, and then other communication aspects are about 20%. But they've got all these growth areas. You know, it's just like Micron or AMD or NVIDIA finding all these ways to grow, you know, in mobile, in the data center, in smart autos. Here's a nice snapshot from them of the growth of connected devices. Wanted to look at something else on here. Well, if you have the time, just go and look up these presentations. You just go to NXP Investor Relations, and you'll find they have this NXP teach-in series. And this is where I got these two decks from, the May 12th deck and the March 17th deck. Let's go look at the hard numbers, the growth estimates that make NXP a Zacks number 2 rank right now. So I'm here on the detailed estimates page. And so we're looking at, for sales this year, growing 22.5% to bust over 10 billion. Very nice to see. Leaving behind, NXP investors who, when the Qualcomm deal didn't go through, I remember it was like the share price would have been like $125 or something that you would have gotten, and now NXP's trading near 200. I think it has room to 240 by next year. In this semiconductor shortage and whatnot. So next year, the estimates are only showing 6% growth because, analysts don't have the visibility. The other thing that I saw Mark Lepacius talk about was that I've been talking about this for years with the tech super cycle, is that we always get the head fake with, the top in the semiconductor cycle. And there really hasn't been. They have these mini troughs and corrections, and they come right out of it because of the demand in all these areas: mobile, data center, autos. So let's take a look at earnings growth. Real nice steady earnings growth, also 22.5% on the bottom line, and looking at 10% next year. I expect these next year's estimates to go up. So look to be a buyer of NXP Semiconductors, on dips, 180, 190. Looking for 230, 240 next year. All right. Next up is Nina with her top pick.
Thanks, Kevin. My pick is a home builder. It is Pulte Group, and the ticker symbol is BHM. Now, housing is one of the areas, very few red hot areas of 2020, which has remained hot this year as well. And we know that the main reason for this housing boom are low mortgage rates and migration from cities to the suburbs. And last year, sorry, existing home sales surged to their highest level since 2006. Now, this year, in the past couple of months or so, sales of existing and new homes have come down slightly, but that is mainly due to lack of inventory. There are not enough houses for sale on the market, and prices continue to rise. So, affordability is also becoming a concern. But prospective home buyers now hope that with the rising rates of vaccination and opening of economies, maybe more homeowners will put their homes for sale in the coming months. Now, talking about the company, it is one of the largest home builders in the US with operations in more than 40 markets across 23 states, and they offer a wide variety of homes, single family homes, townhouses, condominiums, and to all variety of buyers, including first time buyers, move up buyers, and active adults. Now, some investors are concerned that housing may not remain hot, and we have seen that housing markets seem to be taking a breather after a very hot run over the past year and earlier this year. But if we look at the longer term expectations, Americans are forming households at a record rate, and there is a shortage for housing. The housing market is in fact currently 3.8 million single families short of what is needed to meet the rising demand, and that is according to Freddie Mac. And so that is why home builders will need to construct between 1.1 million to 1.2 million single family homes per year to meet this demand. So I think over the longer term, the outlook for home builders remains positive. And many investors also worry whether this housing boom is similar to the housing bubble of 2007. But no, 2007 and 2008, the housing rally which came before that, that was driven mainly by speculation, whereas the current one is being driven by real demand, and lending standards are much higher. In the mid 2000s, banks were allowing borrowers with very poor credit also to buy homes that they could not afford, and those subprime mortgages were mainly responsible for the collapse of housing. So I think this housing boom is very different from then. Now, to learn more about this stock, let's take a look at some chart on Zacks.com. So you will see that it is a Zacks rank 1 strong buy stock, and the industry rank is in the top 3%. And the company reported better than expected results, with earnings surpassing the Zacks consensus estimate. And that is why you will see that analysts have been raising their estimates for the current and next year. And that is the main reason why the stock has gone to Zacks rank number 1. Now, looking at the longer term price consensus and EPS surprise chart, you will see that the company has never missed in the past 5 decades. So beautiful chart. Now, this stock is up almost 30% this year, but it has come off from its recent high, because as I mentioned, that housing industry and housing stocks seem to be taking a breather after a record run over the past year and earlier this year. So I think given the long-term outlook, the stock is still worth a look, and also because of its excellent Zacks rank, stock rank, and the industry rank. And despite this run, you will see that it is still trading at a very attractive multiple of 6.99 times forward earnings. Now, home builders normally trade at a discount to the broader market, but this current multiple is attractive even looking at the past 5 years average for this stock. So, given reasonable valuation and attractive stock rank and the industry rank and attractive outlook for housing market over the longer term, I think stock is worth a look. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and we will see you next week with some more interesting picks.